Hey everyone, Alex here. Welcome back to the channel. Today we are going to deconstruct what might be the most mathematically flawless, technologically terrifying, and legally untouchable financial operation in modern history. We are going to look at a 14-minute window where $2.08 billion changed hands, perfectly timed to the exact second of a geopolitical shockwave. Let us start with the raw data, because the numbers here tell a story that human emotion simply cannot grasp. It is Monday morning, 6:49 a.m. Eastern Standard Time. The sun is barely up on the East Coast. The traditional stock market does not open for another 2.5 hours. The trading floors are mostly empty, but out in Mahwah, New Jersey, inside heavily air-conditioned server farms, the matching engines for the global futures markets are humming. At exactly 6:49 a.m. someone, or a highly coordinated network of someones, drops a neutron bomb on the commodities market. In the blink of an eye, the trading volume for Brent crude oil futures goes from a sleepy 20 contracts per minute to an explosive 1650 contracts. Over the next 27 seconds, exactly 6,200 Brent crude futures contracts are violently dumped onto the open market. We are not talking about a few guys trading on their laptops in a Starbucks. This is institutional, weaponized capital. Those 6,200 contracts represent 6.2 million barrels of actual physical oil. The notional value sitting on the ledger is $580 million. This entity is aggressively, almost pathologically, shorting oil. They are betting massive amounts of capital that the price of global energy is about to fall off a cliff. But that is only half the architecture of this trade. At the exact same fractional millisecond, on a different server rack, an even larger order hits the Chicago Mercantile Exchange. $1.5 billion is aggressively slammed into S&P 500 E-mini futures. But this time, they are going long. They are buying the market. They are betting that the top 500 companies in the United States are about to instantly spike in value. Speaking as an engineer who has built high-frequency matching engines, I can tell you that when you see a paired trade of this magnitude executed with this level of synchronicity, you are looking at algorithmic perfection. The logic is a perfectly balanced equation. Short the oil, long the stock market. You only put this specific trade on if you know with absolute mathematical certainty that global energy prices are about to crash and corporate equities are about to soar. In the context of that specific Monday morning, there was only one scenario on planet Earth that could trigger that exact dual reaction. Peace. The sudden, unexpected avoidance of a massive war. Now, let us move the timeline forward by exactly 14 minutes. It is now 7:04 a.m. The President of the United States opens the Truth Social app on his phone and publishes a post. He announces that he has just concluded a highly productive, incredibly positive phone call with leadership in the Middle East. He officially declares a 5-day suspension of all planned military strikes against Iranian energy infrastructure. The moment that data packet hits the public internet, the algorithms passing his social media feed trigger an avalanche. Brent crude oil instantly collapses. It falls from $110 a barrel straight down to $86 a barrel, a 14% catastrophic drop in a matter of seconds. Simultaneously, the S&P 500 futures violently gap up, spiking 2.5% before the retail public has even finished pouring their first cup of coffee. 54 minutes later, the dust settles. That $2.08 billion paired trade is cashed out. The profit on that 14-minute hold is utterly staggering. It is precise to the microsecond. The problem here is the timeline. There were no economic reports scheduled for that morning. There were no Federal Reserve speakers on the docket. There was absolutely zero public information available to justify a sudden multi-billion-dollar pivot from wartime panic to peacetime euphoria. An analyst covering the energy derivatives desk later noted that a trade of this size placed in the dead zone of a Monday pre-market was 6 times the normal volume for that specific time slot. It was a statistical anomaly that screams of pre-knowledge. Someone knew they did not guess. They did not run a predictive model. They knew exactly what the president was going to type into his phone before he hit the post button. To truly understand the sheer audacity of this 14-minute heist, we have to look at the macro environment of the world on that specific morning. We have to understand the underlying logic of the fear that gripped the market. It was late March 2026. For the previous 24 days, the United States, Israel, and Iran had been engaged in a rapidly escalating kinetic conflict. This was not a proxy war anymore. This was not a trade dispute or a round of diplomatic sanctions. This was live fire. Missiles were crossing international airspace. The entire global financial nervous system was fixated on one specific geographic bottleneck, the Strait of Hormuz. If you look at this through the lens of systems architecture, the Strait of Hormuz is the ultimate single point of failure in the global supply chain. It is a narrow strip of water, just 21 miles wide at its narrowest point. But through that tiny choke point flows roughly 20% of the world's daily oil consumption and a massive percentage of its liquefied natural gas. It is the jugular vein of the industrial world. If Iran decides to mine that strait or sink a few commercial tankers to block the shipping lanes, the global energy grid essentially suffers a distributed denial of service attack. Oil had already been pricing in this doomsday scenario. Brent crude had skyrocketed to $110 a barrel, representing a 40% premium built entirely on the fear of war. The daily trading volume for oil futures had exploded from a baseline of 300,000 contracts a day to well over 1 million contracts a day. The market was a powder keg. The VIX, Wall Street, primary fear gauge was hovering above 31, which is the financial equivalent of a fire alarm ringing non-stop in your living room. Every institutional desk, every hedge fund manager, and every commodity trading advisor in the world was positioning for the worst. The president had issued a very public, very rigid 48-hour ultimatum to Iran. Unblock the strait, cease the military posturing, or the United States military would systematically dismantle Iranian power grids and oil refineries. The market was universally betting on the bombs falling. Nobody wanted to be caught shorting oil if a massive refinery complex suddenly went up in flames. The war premium was locked in. If the strike happened, analysts were projecting oil could instantly breach $150 a barrel, which would trigger runaway global inflation, force the Federal Reserve to aggressively hike interest rates, and push the Western world into a deep recession. Everyone was waiting for that 48-hour deadline to expire. Everyone was holding their breath. But while the entire world was waiting in terror, somebody out there was quietly laying down $2 billion in the opposite direction. When normal people hear about a trade like this, the immediate assumption is classic corporate espionage. Someone bugged the Oval Office, or someone hacked a secure server, or a rogue staffer stole the president's itinerary and sold it to a hedge fund. But there is one trader who completely rejects that narrative, and his perspective is the key to unlocking this entire system. On the popular financial analysis platform Seeking Alpha, there is a highly respected, highly anonymous institutional trader who operates under the handle Pop Whiskey. On the afternoon of this massive trade, while the SEC and the financial media were running around trying to figure out what happened, Pop Whiskey published a deeply technical, incredibly arrogant postmortem of the entire event. He laid out the exact timeline. According to his post, at 6:47 a.m., a phone call was initiated. We do not know who called who, but we know the call lasted exactly 90 seconds. A 90-second transmission of data. Following that call at 6:49 a.m., the massive futures orders were routed into the exchanges. Then Pop Whiskey described the agonizing wait. From a founder's perspective, when you look at the psychological toll of holding a massive, highly leveraged position, 14 minutes can feel like a decade. He described sitting at his multi-monitor workstation. On one screen, he had the live order book for the CME futures. On the other screen, he had the web interface for Truth Social open to the president's profile page. He wrote that he sat there, his finger hovering over his keyboard, pressing F5 to refresh the browser every 4 seconds. He refreshed that page over 200 times. He watched the server traffic data, he watched the order flow, and he waited for the absolute certainty of his profit to manifest on the screen. When the tweet finally populated at 7:04 a.m., he did not cheer. He just watched the algorithms execute his take-profit orders. He wrote that the intelligence gathered in that 90-second phone call yielded roughly $60 million in net profit for his specific pod. But it was his concluding paragraph that truly exposes the rot in the financial architecture. People were accusing him in the comments of blatant insider trading. They were telling him he was going to federal prison. His response was chillingly clinical. He wrote that insider trading is a concept invented for movies. He said that people assume the game is rigged because they do not understand how the machine actually works. To say a system is rigged implies that a piece of the machinery is broken or functioning outside of its parameters. He stated clearly that absolutely nothing was broken. Every single component of the modern financial system was operating exactly as it was engineered to operate. The anonymous offshore trading platforms, the high-frequency colocation servers, the automated sentiment analysis algorithms, scraping social media, and the completely gutted regulatory agencies. He ended his post with a sentence that should be taught in every finance class in the country. He wrote, "I did not exploit a vulnerability in the system. I am the system." When a Wall Street operator tells you something like that, you have to realize they do not view the market as a place for fundamental capital allocation. They view it as an extraction engine. And the reason this specific extraction engine works so flawlessly is because March of 2026 was not the beta test. It was simply the fully optimized version of a strategy they had been running for over a year. To understand the system collapse and the climax of this trade, we have to rewind the tape back to the previous year. We have to look at the 9th of April 2025. This was the proving ground. In the spring of 2025, the United States stock market was taking a massive beating. The administration had launched an unprecedented, aggressive global tariff campaign during the first quarter. The stated political goal was to force manufacturing supply chains to reshore back to the United States and to aggressively shrink the trade deficit. The political base loved it, but Wall Street absolutely hated it. The S&P 500 had bled out, dropping 17% from its all-time highs. Global equities were drowning in a sea of red ink. Supply chains were freezing up, corporate earnings guidance was being slashed across the board, and the fear of a massive global trade war had pushed investors into a state of pure panic. On the morning of the 9th of April, at exactly 9:37 a.m., just 7 minutes after the opening bell in New York, the market was in freefall. Retail investors were capitulating, liquidating their 401ks, selling their index funds at a massive loss just to stop the bleeding. At that exact moment of maximum psychological pain, the president published a tweet on Truth Social. It was short, punchy, and typed in all capital letters. It simply read, "This is a great time to buy the dip." On the surface, it looked like a standard political attempt to soothe a panicking public. The president stepping up to the microphone to tell the citizens that the economy is fundamentally strong. But underneath the surface, in the hidden plumbing of the options market, something highly abnormal and deeply sinister began to happen. Immediately following that tweet, massive institutional volume began pouring into one of the most volatile, mathematically dangerous financial instruments ever conceived by Wall Street. 0 days to expiration options, 0DTS. Let me explain the mechanics of a 0DT option, because it is crucial to understanding the fraud. An option contract gives you the right to buy or sell a stock at a certain price. But options have an expiration date, and as that date approaches, the premium you pay for that option decays. This is called theta decay. A 0 days to expiration option is exactly what it sounds like. It expires at 4 p.m. on the exact same day you buy it. It is the financial equivalent of a lottery ticket that bursts into flames at the closing bell. If the market does not move aggressively in your direction, by the end of the trading day, your entire investment goes to absolute zero. On the morning of the 9th of April, with the S&P 500 already down 17% on the year and still actively crashing, shadowy institutional buyers began purchasing hundreds of millions of dollars worth of out-of-the-money, 0DTA call options. They were betting that the market was going to violently reverse course and explode upward within the next 6 hours. As someone who has managed corporate treasuries and dealt with institutional risk models, I can assure you that buying massive blocks of 0DTE call options into a crashing market is completely unjustifiable and it is financial suicide. You are virtually guaranteed to lose your entire premium to theta decay. You only allocate capital to a trade that's dangerous if you possess an asymmetric information advantage. You only buy that ticket if you already have the winning numbers in your pocket. The market continued to chop around nervously for a few hours. The algorithms were digesting the volume, the retail traders were still selling, and the 0DTA options were slowly bleeding value. Then, at exactly 1 to 1:08 p.m. Eastern Street Andard time, the White House press office released an official statement. The administration formally announced a sweeping 90-day suspension of the newly implemented global tariffs. citing the need to allow international partners time to negotiate fair trade frameworks. The market reaction was violently instantaneous. It was the largest single-day short squeeze in modern financial history. The S&P 500 ripped upward, closing the day with a staggering 9.5% gain. Nearly $4 trillion of market capitalization was spontaneously regenerated in a matter of hours. The Nasdaq Composite, heavily weighted with tech stocks that rely on global supply chains, melted up by an unbelievable 12.2%. The Dow Jones Industrial Average added 7.9%, and those mathematically suicidal zero DTA call options purchased earlier that morning, they went completely nuclear. Depending on the specific strike price, some of those contracts returned an astronomical 2100% in less than 4 hours. Who captured that alpha? It certainly was not the retail investor sitting at home trying to decipher the president's social media feed. Retail was busy panicking. The entities that extracted that $4 trillion wealth transfer were the high-frequency quantitative funds, the highly connected macro hedge funds, and the Washington insiders who knew exactly how to position. When you juxtapose the April 2025 tariff reversal against the 20th of March 26 Iranian Street and Down, you see the exact same architectural blueprint, the exact same methodology. The only variable that changed was the latency, the execution window. In 2025, the gap between the cryptic social media signal and the official policy realization was roughly 4 hours, a relatively wide window that allowed multiple institutional players to quietly build their option positions without triggering too many circuit breakers. But by 2026, the system had optimized itself. The participants had refined their models. The window of opportunity collapsed from 4 hours down to just 14 minutes. They did not need the president to tweet a vague hint anymore. They had direct, actionable intelligence 14 minutes before the official announcement hit the wire. They had perfectly minimized their time exposure to the market while maximizing their leverage. This evolution of strategy birthed a completely new quantitative paradigm on Wall Street. The quants, the brilliant mathematicians and physicists who build the pricing models for the hedge funds, realized they were no longer analyzing corporate balance sheets or discounted cash flows. They were analyzing human psychology. Specifically, they were analyzing the psychological pain tolerance of the commander-in-chief. They built an algorithmic trading strategy and gave it an acronym, TACO, T as CEO Trump always caves out. It is a deeply cynical, incredibly revealing name. To the quantitative engineers building these models, the geopolitical maneuverings, the threats of war, the tariff escalations, these were not matters of national security or grand diplomatic strategy. They were simply inputs into a volatility matrix. The core thesis of the TACO algorithm was breathtakingly simple. The president uses extreme threats to initiate negotiations, but his administration has an incredibly low tolerance for severe stock market drawdowns. If he pushes a policy that causes the S&P 500 to drop past a certain algorithmic threshold, he will predictably reverse course to rescue the equity markets. Therefore, the quantitative strategy was completely mechanized. When the administration announces a massive escalation, whether it is threatening to annex Greenland, starting a trade war with Europe, or preparing to bomb Iranian infrastructure, the TACO algorithms immediately short the market. They push the volatility higher. They help drive the prices down. Then, once the internal metrics indicate that the market pain has reached the administration's breaking point, the algorithms aggressively flip their positioning. They cover their shorts, buy massive amounts of leveraged long positions, and patiently wait for the inevitable diplomatic retreat. They wait for the cave out. Throughout 2025, this algorithm printed money. It became a self-fulfilling prophecy. But applying the TACO framework to a trade dispute is one thing. If you get it wrong, you lose some capital on a bad options play. Applying the TACO framework to a kinetic military conflict with live munitions is a completely different level of systemic moral hazard. In early 2026, when the missiles started flying in the Middle East, the TACO algorithms blindly executed their standard playbook. They assumed the president was bluffing. They assumed he would ultimately back down to save the stock market from the inflationary shock of $150 oil. So, while the military was spooling up fighter jets and moving aircraft carriers into position, the quantitative funds were aggressively shorting oil and buying the S&P 500. But here is where the system architecture becomes actively dangerous to human life. Financial markets are supposed to be price discovery mechanisms. They are supposed to reflect the fundamental reality of supply and demand. If a war is breaking out and oil shipments are about to be choked off, the price of oil must rise to reflect that scarcity. That price signal is necessary to incentivize alternative energy production and to force conservation. But the TACO algorithms broke the price discovery mechanism. The sheer volume of synthetic short selling from the quantitative funds artificially suppressed the price of crude oil. The physical reality of the war dictated that oil should be screaming higher, but the financial derivatives market was pinning the price down. When the administration looked at the economic dashboard, they saw a distorted reality. They looked at the price of oil and thought, the market is stable. The energy grid is holding up. We do not need to rush to a ceasefire. The economy can sustain this conflict for a little while longer. Do you see the feedback loop? Wall Street was betting billions of dollars on a peaceful resolution, but their massive bets were artificially suppressing the very economic pain signals that would normally force a quick diplomatic resolution. By shorting the war, the algorithms actually extended the duration of the conflict. The quantitative models optimized for yield were effectively keeping young men and women in combat zones for extra days, simply because the price of oil had not yet breached the administration's pain threshold. When algorithms detached from physical reality dictate capital flow, the human cost is entirely externalized. Now, we come to the postmortem. We come to the rebuilding phase where we try to understand why this architecture is allowed to exist. The evidence is permanently recorded on the immutable ledgers of the exchanges. The 14-minute timeline is an undeniable historical fact. The $2.08 billion volume spike is logged in the CME databases. The Seeking Alpha confessions are archived on the internet. So why did no one go to federal prison? Why were there no perp walks, no massive SEC fines, no congressional tribunals breaking up the funds? The answer lies in the deeply flawed, intentionally obtuse structure of American securities law. In software development, we call this an unpatched zero-day exploit. Wall Street knows the exploit exists. Washington knows the exploit exists, and neither side has any financial incentive to push a security patch.